Raamdeo, hi, good morning. Great to have you on the show. Raamdeo, we often debate about growth versus value. Right now, it seems value seems to be winning.
Yeah, good morning. Actually, for a very long time, like I would say 5, 7 years, it has been one way the growth stocks have been doing very well. And in a lot of cases, it overstretched itself in terms of valuation. And on the other hand, the value stocks were beaten down so much that they got overstretched on the undervaluation. So there has to be some rebalancing of the valuation has to happen.
Yeah, absolutely. So in this rebalancing, Raamdeo, what is it that you think is the desired value pocket, and where out of growth would you say it's time to exit now?
Yeah, excessively priced growth stocks may not do well for the investors because ultimately you can get out only as much as the company's worth is, and if you have overpaid for the company's worth, obviously you end up making suboptimal return. And where in value, if by chance you are underpaid, I mean, like for 10 rupee thing you are paying only 3 or 4 or 5 rupees. Obviously, it will catch up and it will give a superior return than what the market returns are. So it all depends on the individual stocks, and all the growth stocks are not bad, and all the value stocks are not great. So you have to figure out where exactly the opportunity lies.
Right. The other thing in the market which is also playing out, Raamdeo, is the inflationary repercussions and the kind of bearing that they're going to have on growth as well as margins of the companies going forward. I mean, if you talk about crude, if you talk about agri-commodities, this commodity price inflation just pretty much across the board, and of course metals as well. How do you think that's going to play out? Because there is only that much that companies will be able to, pass on as raw material costs on to consumers. Beyond a point, it's going to either impact their margins or volumes.
Yes, I think in the short run, data is all over the place, in the sense that the oil, which was 19, 20 or $25, has crossed $70. So a lot of things are not in place. Now, are they short-term trends? Are they long-term trends? It's very tough to figure out. But today morning I was reading the paper. The corporate confidence, business confidence, has shot through the roof, and it has gone to 74, which used to be more like 57, 58 or less than that. So how the businessman is so confident, I mean, that is what is really more important, in the sense that they are confident of when they are saying they are very confident, means not only the top line will grow, but also they must be optimistic about the profitability of the business. So it is at a company level, all these things will get adjusted, in the sense that whatever is the raw material spike, if the demand is very strong and they can pass on, then obviously on the higher sales they can make more profits. So it's a very complex situation, but I can see that inflationary rise in the prices of steel and all kinds of commodities are going to play havoc with maybe even the March quarter results. In some cases, results are going to be impacted by the commodity prices, and but how do we see longer term? That only time will tell. But right now, I'm just watching about this commodity inflation.
Okay. Raamdeo, on the cyclicals then, and that's been the area of focus, in the recent weeks. How bullish are you on the opportunity going forward? And within that, financials, let's talk about that first. We've got a whole spate of privatization news that's been causing a lot of buzz when it comes to, some of the select PSUs. We've also got some more consolidation that's expected and windows opening up for some of the smaller private sector names and NBFCs as well. Where would you be focusing your attention within that basket?
Yeah, so BFSI, particularly banking, insurance, asset management, NBFCs, housing finance, these are all very large segments of the market, and clearly they have been beneficial. In fact, they suffered. I mean, at least the banking lenders, they suffered big time, not only in terms of actual losses, but also in terms of stock prices. So in the first half of 2020, they were the worst sufferers. And now from there, they have provided, government has given a lot of reliefs. There is a massive liquidity, low cost of liquidity. And so all kinds of things have happened in the sector. And it looks they have provided well, and economy is on the mend. And just that high liquidity and very rapid recovery in the economy is the best news for the lenders, because all kinds of stress, whether it is borrowers, individual borrowers, or the corporate borrowers, as the business picks up, the ability of the companies to repay to the banks, that goes up, and hence the credit cost that comes down as the economy recovers. So as the economic recovery is expected in next 12 months at about double-digit kind of thing, 11-12%, I think the stress on the corporate books will come down, and that's what the optimism is in most of the lenders. I mean, what I hear amongst the biggest of the lenders is that their credit cost, even in March quarter, will be much lower than what was expected by the analysts. So I think that's a good sign at the early stage of the recovery.
Okay. That's on the financials then. And when it comes to the broader cyclicals, or also, the whole infra play and the ancillaries on that front in terms of building materials, commodities, the entire segment that comes together when it comes to the kind of project rollout that we're anticipating and the kind of buzz that we're seeing on the infra side, what's the kind of outlook you have on that front as well?
Yeah, so a lot is happening, particularly on the infra side. Then PLI scheme, there are individual companies which are positively impacted, and the growth momentums have started. So they're all about the growth, and in some cases, re-rating also. So cement, steel. So I think if you see the markets, the growth momentum and the earnings re-rating is happening across the board. I mean, you've got to be really focused at this point of time into your stocks, your companies, and the opportunities are coming up from various sectors. I mean, infra is clearly there, and order book of all the infra companies are building up very rapidly. So clearly, the opportunities to invest in many of these companies are coming up, and one is slowly making changes in the portfolio. But too much of changes in the portfolio is also not good, in the sense that typically what happens is you get out of what has not worked and you try to get in what has worked recently, which was not there in your portfolio. And in that process, typically what we have seen is that you end up selling a stock which is undervalued, and you end up buying something which has already been fully discounted the optimism. So one has to be very careful in balancing the portfolio. You have to be ahead of the curve. So in all these places, wherever you find something which is you are ahead of the curve, valuations are reasonable, clearly we are making those changes.
Right, Raamdeo, good morning. Just wanted to get in your take on, some of the recent listings as well. We've had a lot of IPOs bombard the markets, from the Indian Railway Finance Corporation, Indigo Paints, Mrs. Bector's, a number of them. Anything within these recent listings or anything in the upcoming listings of 2021 that you're particularly looking out for? What you've made of the business prospects of any of the businesses that stand out?
Yeah, see, actually, good thing is that all the new issues are of very high quality companies. The only issues are that there's so much of liquidity in the system that somehow these companies are getting completely mispriced at the time of listing. Because in application itself, you don't get any allocation. And when you go to buy in the market, in any case, the promoters, they offload at a high price. And then on top of it, there's 40-50% premium at the time of listing. So it gets completely outpriced in terms of buying them. So it would be better to buy some of the companies in the sector, which are old companies in the sector, which might be available at half the prices, half the valuation of the listing prices of some of these companies. So we have seen some wonderful companies getting listed. But the whole challenge is, does it make sense to buy into them at the time of listing? So you have to be very careful. There are opportunities at times, even at the time of list, because these are new companies, new stories. They're not very large in size. They might be little larger mid cap kind of thing at 10, 15,000 crores kind of market cap. So they have a lot of growth momentum left, and it is new to the stock market. So the story is not well known. So there are good opportunities in these companies, but one has to be extremely careful at what price one gets into the stock.
You know, there's been a lot spoken about digitization of the economy, transferring to tech, pivoting business models completely. Is there anything within the Indian listed space or any upcoming companies that you would look at to drive this theme forward?
Which theme you're talking about?
Digitization, technology.
So we are going to see a lot of these unicorns which are there right now. I think we are going to see some of the very promising ones are going to come in the IPOs. And since India has missed out on digital companies, but now our turn has come, and next 3, 4, 5 years, we are going to see a lot of these digital companies coming in for IPO and listing. And we'll have our share of e-commerce companies in the listing. So it all depends on, I mean, in that process, you'll also get completely what you call non-profitable companies at some fancy prices. So you have to be careful. I mean, my competence to judge these kind of companies are low because they are not typically profit-making companies. There are a lot of promises on various other fields, but profits. So one has to understand what are the outlooks for the these companies going deep into the future. So I think digital investing will start here, and one has to look forward to it. We'll also participate surely, but yet again, it depends on company to company. All sorts of companies are going to come.
Raamdeo, I have to ask you about Warren Buffett's latest commentary that came in on the sidelines of the Berkshire AGM. And many were intrigued about more what was not said as opposed to what was said. There was no mention about the rebound in the markets, no mention about niche categories like SPAC. All that was mentioned very categorically was about bond markets and that fixed income is not going to give you as returns. But there was no commentary and direction per se on what should you be doing with your money. What's been your takeaway?
Vocal about stocks being superior than the bonds, and he has means no words in terms of saying that bonds are kind of a very bad asset class right now, because the high interest rates, they apart from the yield, it also takes care of the mistakes in the business risk which are associated when you lend it to somebody. But if you are giving 1% or something like that, so clearly the bond is completely returnless risk kind of situation. So bond, he was very clear, and he's also very clear that equities are going to do better in this situation than the bond. Now, this particular letter has, actually, it is one of the shortest letter, 14 pages against 23, 24 pages. And actually, there is not much except for talking about his own investment buckets and the companies. And I think this time what I'm getting to hear from the letter is the power of repurchase, buyback by the companies. And he himself has bought back about $25 billion of stocks of Berkshire Hathaway last year. And he's also gone overboard in talking about buyback, power of buyback in Apple computers. So combined, so basically he's been lauding a lot about the buyback of the companies which he is owning. And another thing which he has actually repeated, but finally he ends up saying, is that what is the kind of companies he is looking for. At the end of it, what works for him and what one should look for in the companies. And that I thought is the best summary of what the guru Warren Buffett has reached to say. So where he says the best results occur at companies that require minimal assets to conduct high margin businesses. The best results occur at companies that require minimal assets to conduct the high margin businesses. So minimal assets and high margin business, and offer goods or services that will expand their sales volume with only minor needs for additional capital. So that seems to be the kind of a core of this particular letter. And he says that he wants few of them like Seas Candies and all, but very difficult to find these kind of companies. So asset light model and less and less asset intensity for future growth. So he has talked about quality and growth, and obviously the margin of safety is an integral part of the investing. So, but this letter per se doesn't talk much about anything else.
Yeah, indeed. And Raamdeo, if you were to draw that same analogy to Indian stocks, very few actually fit the bill, which are asset light, high margin businesses, and have visibility of growth going forward. I mean, to my mind, that's only IT as of now.
Yeah. So no. Why all this? See, if you ignore the pricing part of it, then there are, I would say 40, 50 companies are there which would qualify here. Just that prices of those companies are not great in the sense that, of course, IT will come fully out there. Even some of the pharmaceutical companies will come there with 35, 40% EBITDA margin. Those companies are very good. And they're not, they're not like 80, 90% ROE, but 25, 30% ROE business, I would say it's reasonably high. And 25, 30% growth. So, but then they are available at 80, 90p. So there are a whole lot of companies which are high margin, low asset, this thing, and has reasonable growth. The issue is to find them at reasonable price. That's the key issue.
Okay, great. In terms of some of the other pockets of the market, Raamdeo, I also want to get a sense from you. There's been a bit of a debate brewing when it comes to consumption and whether or not we're going to see a petering of the trend or whether things are actually going to pick up in line with the economic recovery. And that, of course, is a bigger debate when it comes to discretionary. I want to get your take on that. The staples have anyway been trending at premium valuations, but big questions about an urban recovery there as well.
Yeah, so we are talking to the companies, on the same lines, and you are interacting with them every day.
Okay, we'll go back across to Raamdeo in just a minute. I think we've just lost the feed momentarily, and we'll just reconnect. I'm just going to take a look at what's happening in the markets. We're up close to 1%, so looking good. BEML, of course, in news on the back of some of the auto majors looking to pick up a stake in the defense company. So 12.5% there. Just Dial is up 6.5% today. GAIL also 6.5%. ONGC, Adani Power, Adani Gas. The entire oil and gas basket is actually looking very strong right now. Bharat Forge 3-4% coming in there. We've got Container India 3.5% as well. Steel Authority of India sale is bouncing back. Motherson's up about 3% today. UPL is looking good as well. So that gives you a flavor of what's actually moving higher. BHEL, Tata Power, some of the other names. So a lot of these old economy counters that are actually moving in today's session. Raamdeo, we lost your line there, but please do continue that thought.
Yeah. So what were we talking?
We were talking about the consumption companies, and you were mentioning how in your conversations with them, you've also been asking them similar questions in terms of the outlook.
So, outlook looks to be pretty good at this juncture. And as the new year starts, I think government's own constraint till 31st March to manage the finances of this year. But the next year, I think will roll out with a full recovery in the GST, and I think their fiscal situation will be much better, and hence with the 6.5 or 7% of fiscal deficit, I think we should start with a bang. I mean, the 21-22 should start with a lot of impetus, and so I think outlook right now looks very good for the year ahead in terms of business recovery. And in any case, vaccines are there, and rollout is happening very rapidly. So my sense is in the first half, bulk of the vaccination will be over in India also. So it looks we are in a very good wicket, and we have to. And the stocks have done very well from March lows of last year. It's almost up 100% from the bottom. So I think it may cool off somewhat here because it has been quite rapid. And I think the real thing is coming from bond yield spike in the US and the kind of uneasiness out there in the US markets. So that may play some kind of consolidation game for some time. But our own recovery, our own corporate earnings pickup will, kind of play out in the marketplace.
The other debate everyone's been talking about, particularly given the kind of sensitivity we saw to the global action last week, the fact that while we've been riding high on flows, global markets just have to sneeze and we catch a cold. So going forward, do you feel that the domestic action will really be enough, will be strong enough to insulate us from any such volatility? Because the bond markets have been playing havoc with sentiment, of course.
Cannot give you full insulation. You cannot, if the Americans or FIs, they sell 2,000-3,000 crores every day, clearly it will break the trend here. But that's about the market. But as far as the individual stocks are concerned, I'm quite sure wherever there is a strong earnings momentum, that can kind of really override this particular correction and move forward. Because earnings have been depressed for a very long time. So the companies which are coming back with the earnings momentum, they are pretty strong. So I'm quite sure wherever earnings momentum is there, it can take care of the market correction broadly.
And what's the sense that you're getting when it comes to the entire cement basket and how you're looking at prospects within this space? Is this a theme that would interest you, largely owing to the cost inflation drive up as well as the kind of robust demand that we've seen across the board? I know you spoke of the overall infra related themes, but if we were to get a little more specific?
Yeah, I think in infra theme, cement is a better bet because cement has a more application than just the infra. They have the housing demand also being held by that. And cement is a non-tradable commodities broadly, globally. So you have to make it for yourself in India. Even within India, north, south, east, west kind of a thing is there because it's a very logistic intensive. So clearly, whereas steel and all, they can be imported. And cement is clearly local play. And hence the local demand supply will play out well. And we have some wonderful cement companies in India. So I think that's where I would say that one of the plays for the infra or recovery would be cement, clearly.
Okay. Raamdeo, I wonder what exactly your advice would be when it comes to diversification of the portfolio into various asset classes, debt, real estate, looking at the commodities like gold, etc. What do you think would be the ideal mix?
See, diversification is very powerful, but beyond 15-20 stocks, or say, I would say 7 to 8 businesses, if you are buying banks, then obviously you cannot buy one bank of 30%. So you'll have 3-4 of them to accommodate, say, 30-35% in your portfolio. So in insurance, in automotive, so everywhere you'll have more than 1 or 2 from one sector. So I would say, if you build a portfolio of about 25 stocks, you need to have about 7-8 industries, which you should know better. You should know well. And within them, then you buy whatever best values you get. So diversification is very important. And which way the wind will blow, one in the economy and second in the market, that nobody knows. maybe about the companies we might be better appraised, but not about what the markets will do. So we are in very uncertain environment. At this point of time, we were thinking that market is going to collapse. I mean, it is going to be completely lose-lose kind of situation. And here we are sitting with 100% gain. So it has been very counterintuitive in terms of what markets are doing. So some of the predictions are that global economy will boom, but stock markets may not do as well in next 12 months. That's what I'm hearing from some of the experts. So we have to be very cautious. We have to be well diversified, and we should be very clearly holding companies where you are comfortable to hold them, even if it doesn't do well. And what is most important in buy and hold is you should be able to hold when the stock price is adversely hit, and hence diversification has to be to the extent you understand the future of those companies which you have in the portfolio. Having 50 companies or 60 companies and not understanding them is also of no use.